when you have cancer, the day before you got your cancer diagnosis, your number one problem was work, followed by my spouse is angry at me for not cleaning the dishes, followed by I don't have time to hang out with my buddies. That's your number one, number two, number three problem. And then you have cancer, that's your number one problem, right?
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
So what I'm going to do is I'm going to go next piece, which is talking about the unfair advantage and economics, but some startup fundamentals. What are Southeast Asia VCs looking at, and what does Jeremy think is a good investment play? So let me just list it out in no particular order. First of all, there is understood in Southeast Asia to be a Series B valley of death right now. So there's a lot of capital by local VC funds that can do pre-seed, seed, somewhat Series A. But Series B, there is a big shortage. There are American funds that are willing to do Series D, Series E, for example, but Series B, Series C is currently considered the valley of death. So because these companies raise a lot of money very quickly, and then after that they kind of hit this cliff where basically there isn't enough capital, and so they have to cut costs or increase revenues quite rapidly. That was not helped by the post-COVID interest rate hike that also shushed off a lot of funding. So that's one. Two is, yes, a lot of Southeast Asia VCs are now looking at tech-enabled plays rather than pure tech. And the key thing is it goes back to time machine. VCs can write a deal for a company today, and in 10 years they become a IPO. But if you time travel 30 years from the future, let me just take an example. So imagine now you're like, I'm in America. I think America is really into robotics. I'm sure that Indonesia would really be a great place to install robots, right? And then you go back in time and you're like, wait a moment, the Indonesia cost of labor is so low as an alternative to robots, whereas in America, the average cost of labor is about 60,000, 70,000 GDP per capita, right? Per person, right? So there's a clear economic incentive to do so. Or maybe for the Chinese factories, they're saying, we have a certain amount of volume that we have to do, but we have a shrinking population for this working class. So unless I want to lose business, I better replace them with robots, right? So I'm just saying, even though China's at 15,000 GDP per capita, they have a certain demand commitment they have to make, so they have to use robotics to increase productivity, right? If you time travel too far from the future, you're like, I'm going to Indonesia to build an advanced humanoid robotics person, I'll be like, good luck to you, right? Because you're literally fighting the price is too low. So what I'm trying to say here is that if you time travel 30 years back into the past, and then the VC makes an investment for 10 years, you're still too early, your company dies, right? It doesn't make enough money, right? So there's kind of a sweet spot, like you kind of want to travel maybe 12 years from the future till today, and they build a company, and so you have to bet the right company. So I think what a lot of VCs have realized is that if you're too tech-oriented, that's way too far away in the future from where the reality and the gravity of the economy actually is, then you're just never being able, the company would take 20 years or 30 years to get there rather than 10 years. So the trick that you have is like, how do I find the right idea? If I time travel machine 10 years in the future, it would be just the right timing. So tech-enabled plays feels a bit closer to reality. So now, obviously, the companies were founded almost 10 years ago, be the food delivery apps, they're still fighting it out. Obviously, we have the data center companies. If you set up a data center company today, you're probably a bit by 5 years. I think education tech, there was a big wave that was being built about 3 to 4 years ago because of COVID. So I think it's a bit late for education tech right now. So it depends on that piece, like what's the right play right now. So if I was a pre-seed startup, I think a lot of them are looking at AI-oriented startups. I mentioned a previous startup that basically buys call centers and replaces them with AI people. So call centers, there's a lot of call centers in the Philippines, right? The BPOs, etc. So there's a bunch of funding that's going there right now. I was talking to my friend recently, and I was like, now's a good time to build a jewelry startup, because if you can build a Tiffany's for Vietnam, and if they can continue growing 7 to 8%, the GDP per capita is about same as Indonesia right now. If you grow 8%, you double your economy every 10 years. So I'm just saying, if Vietnam can maintain this growth rate for 20 years, they can grow 15,000 to 30,000, and 30,000 technically can go to 60,000, right? I'm just saying, obviously, it's a lot to believe. I don't know whether they can keep it up for the entire time. But I'm just saying, now's a good time to build a jewelry startup, right? Because right now people are buying bags and cosmetics in Vietnam, but people are not really buying a lot of jewelry, for example. So it was my friend and this Vietnamese lady and I were just brainstorming like, what's a good startup now to build? Because there are makeup startups that are doing well in Vietnam right now. There are starting to be bag startups that are doing well, or fashion, affordable luxury startups that are starting to do well. So we're just saying like, hey, the next one is going to be jewelry, right? So that could be an example of the right time. But I don't know. I mean, if I knew for sure, then I'll be making a lot of bank really fast, right? So it's hard to tell. But I'm just saying the reason why is that tech-enabled services, tech-enabled startups seem basically, if you're too late behind the curve, you won't make any money. But if you're too ahead of the economy of where it actually is, it's too much technology for the country, then it won't exist as well. Yeah. Well, first of all, Gartner doesn't do really independent analysis of the hype curve, right? So they talk to us and they look at the mentions. So they are actually a lagging indicator of us. So we make money a bit like traders, right? By the time Gartner says that it's on the rise, it's probably the peak. Like it goes nowhere for a while. Similar to vaping, vapes were invented for many years. Then eventually there was a small hype cycle where it became hot. And then after that, it dipped down because everybody hates vapes. And then suddenly now but I think it's unstoppable. I think it'll become 100% market share. If you think about it, you're like, it's just a slow march. Like in 30 years' time, everyone's going to vape instead of cigarettes, right? But the cycle is like the hype cycle. So crypto, the trick there for crypto is always like sell before you get out of here. But when Gartner says, oh, we'll still have room. It's like Jim Cramer, they say, right? It's like Jim Cramer is like, the joke about meme of Jim Cramer is like, if he says buy, by the time there's time to sell, because this guy is like the last to know in the room, right? Gartner says it's hot, then it's probably like, okay, it's time to sell on the VC side. Unless you have a very long hold horizon that can fully deploy over 10 to 20 or 30 years. Yeah. So the question is, will you become a unicorn in 10 years? So I think a lot of VCs will say, okay, like when I meet you, it's like, professional, put together, can communicate well, all this stuff, high integrity, blah, blah. But the question I'm saying, are you going to become a unicorn in 10 years' time, right? So this is what the time travel machine, this is where all the gamblers all come out all of a sudden, right? Because you're like, man, how good am I at telling this? Another way of looking at this is, let's say, Samantha has a company right now that has about $1 million of revenue today, right? So the smaller version bet, do I believe that you can double the revenue by next year, $2 million? And then can you double it again? Can you make it to $4 million? I mean, some people are even more aggressive. Some people will say triple, right? So the yardstick will be, can you make $1 million to $3 million by next year? And then can you make $3 million to $9 million the following year? So I normally use both of these metrics. Like the 10-year is like a different side of me. The short term is a little bit more logical, but a little bit more Excel oriented, right? So more business oriented. But I think you got to keep those two things, because there are some companies can do well in the short term, but cannot do well in the long term. And there's lots of companies that will take a long time and make no money for many years, but then they'll make it, right? So OpenAI had zero revenue for many years. If you were like, is this gonna make money? You'll be like, no, you make zero revenue. Next year, the founder will tell you, for the next 5 years, we'll make no money. And then at the end of it, we're gonna make $1 billion, right? Then you'll be like, wow, this guy's a joke, right? But it turns out he did it, right? He spent many years in R&D, and then eventually now he's out, and now he has a $150 billion valuation, right? As of this week, with Apple coming in, right? So I think we just have to be aware about that. When we talk about this, we need to understand what makes startups different from that. So we have something called Kaizen. So this is a good metaphor for looking at it. But Kaizen is basically, in Chinese, it would be Gaishan, which is, Japanese Kaizen, which is art of lean manufacturing, right? So it means change for the better. And it basically says, historically, automobiles were made kind of like by batch. So imagine all these cars, right? You know what I mean? Imagine this car is being made here, and then the whole car is just made. Everybody brings the materials to that car and assembles the car on that spot, right? Now, obviously, Henry Ford made the assembly line so that there was a line that was going by. And then Kaizen, which is, I think, most popularized by Toyota. So a lot of people like to drive Toyota cars because they're very reliable. But what they said was they created a bunch of practices that basically said, first of all, we don't want to have a lot of inventory stock. We want to order it just in time to become more efficient. We allow every worker to stop the assembly line when they see an error in the automobile, because it's going to be less costly for us to stop the line and fix the problem immediately than it is to do a massive recall later. And so right now, Boeing has like 70 complaints by whistleblowers because everybody knew they were manufacturing defects, and then they were getting rolled over again. And now they have class action lawsuits. They're being stopped. There's a moratorium on. There's a big happening right now. It's very expensive. I was talking to this guy's executive, and he's super pissed because they bought a lot of Boeing. Imagine all your Boeing planes have to stop for 2 weeks, as the airline, you don't make that much money anyway. So if you stop your planes flying for 2 weeks, you basically lost all your profit for the year, right? And so it's super expensive and they're super pissed. But basically this is Kaizen, so it's like a new way of thinking for manufacturing. So a lot of startups will call something called the Lean Startup, and this was obviously very hot 10 years ago. Now I think it's become relatively mainstream, but it may not necessarily be aware by everybody. But basically Lean Startup Method, and it's a book that we recommend, basically says that the most important thing that a startup needs to do is they need to learn faster than everybody else. This is actually quite similar to another framework called the OODA loop, OODA. So it's observe, orient, decide, act. So it was basically saying that if I'm a fighter jet pilot versus another fighter jet pilot, if he can observe, orient, decide, and act on this plane faster than, he can turn that loop faster than me, I will lose to that pilot. So my job is, how do I observe, know where he is? How do I figure out what my position is versus that person? How do I make a decision about good or bad? And then make an action. I need to do that faster than the guy. So if I can do that loop faster than the other guy, my plane wins the dogfight. So that's the OODA loop or the Boyd's loop. So the startup method is actually quite similar. Basically what they're saying is, if I can learn faster than your company, then I will eventually win. Basically, if I as a startup, if I can build something, and then I can, with a minimum viable product, something that gets me the learning, then I can measure, I can get those insights, and then I get this data, and then as a result, I'm able to learn and make a decision about what to do. Then I can build a better version of that product. So it's kind of like this whole process in that sense of being that fast, lean machine, but don't get overblown. You don't build an annual strategic plan. You don't build an annual budget. You're just moving faster and faster and faster. So recently, Paul Graham released this article. It became a hot meme in Subland. It's like founder mode versus manager mode. And then Twitter blew up. And it's like, yeah, managers, all these MBAs from Harvard, they're totally shit. They destroy a company. They're so slow. Founder mode is get things fast. Don't care, get it done, and then just go for it. So this is kind of like the learning loop that we have to go faster and faster. We'll definitely talk about failure patterns and how VCs can do value addition at each stage. I think that in general, VCs will think about it in two ways: judging versus adding value. So I think those would be two ways, right? So judging means, I think this company can scale without me or with very little of my help. And so my job is to get a ticket on this road. Does it make sense? And then the second side, it'll be like, they can't get there, but I can help them get there, right? And obviously it's a blend of both. So judging is just judging, like, is the founder good? The founder have a spirit of learning? Are they able to attract good people? Are they able to delegate? You know what I mean? Those are things that are quite key. And obviously if they've done it before, I mean, the best case scenario is, if Sam Altman exits OpenAI at $1 trillion and he leaves, he says, hey, I believe I can create a startup that, I don't know, going to Mars is already being done by Elon Musk. But yeah, if Elon Musk was like, hey, I want to build a new startup, but now it's going to go to another solar system, then like everyone's going to be like, yeah, no brainer. I can trust that. Now, obviously, there's also a selection piece. Adding value piece is also important as well. VCs can really help. So some VCs are very good at healthcare tech. Some VCs are corporate VCs. Some people, there's lots of ways that VCs can add value as well. So that's how you do it. Either judge it, that they can already scale, or you help them scale. Okay, so I think what startups often do as well is that they often are very much in the mood to do divergence and convergence. Basically, what they do is they have a trigger point, then they say there's a problem, then diverge. I want to get as much opinion, let's brainstorm, let's get lots of different opinions, let me talk to a lot of people. And then after that, they empathize with the user or the problem, then they define the problem, then they start converging on it. So they say, okay, I now understand the right problem. I understand how the problem should be formulated. The problem is not that America wants better quality rockets. The problem is that America wants cheaper rockets. So they're going for bigger, larger, more expensive rockets, right? But basically Elon Musk is that I define the problem as the cost to bring 1 kilogram into space, which requires us to have cheaper rockets. Expensive rockets, but they're reusable. So we define the problem differently, right? Does that make sense? A lot of the Boeing and Lockheed Martin, they were being paid for on a cost plus model, right? So they'll reimburse like our favorite defense and government contracts or utility contracts. So they'll say, Boeing was like, if I make a contract for a $500 million, the government will pay me $600 million, basically, right? It's cost plus 20%, right? Therefore, they were incentivized to build bigger rockets or spaceships. Versus SpaceX was like, I'm incentivized to think about it from a payload perspective because I'm trying to go for commercial payers and so forth. And then, of course, you have a problem statement, then you diverge again, and then you come up with the right solution, and you ideate, you prototype, you test, and then you converge. So the rate of learning is really important. So for example, one of the big differences that SpaceX is versus other people is that a lot of the manufacturers, they have dispersed their manufacturing across as many states as possible. If you're making the fuel line in one place and then you're making the pumps in another state and everything, you divide it all up. And if your funding comes from the government, then it's very hard for Congress or the state senators to vote against you, to come together to lower your funding, right? Because your funding is coming from the Pentagon. And all of that was being done. But for SpaceX, they put all the manufacturing in Los Angeles, right? And the reason I put it in Los Angeles was because they said, hey, first of all, there's a lot of good engineers that were formerly from the Army, the Navy, because of the California base. There's a lot of high-tech people, engineers. But we're going to have everybody be in the same place. There's no such thing as work from home. Everybody's going to be in the same place because we need everybody to be learning how to make things that have never been made before, right? And so we want everybody in the same place, and we're not going to disperse it, right? So the rate of learning was faster because everybody was in the same place, and then they could work together. And it wasn't like computer engineers sending a computer design to the product guy, send it to the manufacturing. It's a bit similar to Toyota in the sense that everybody's all in the same place, right? In Toyota, something goes wrong on the assembly line, everybody's expected to be there. The line manager is supposed to be there, engineer is supposed to be there, everybody's supposed to be there, and everybody's supposed to solve the problem at the same time, right? So there's that dynamic that you see there. So as a result, now we're looking at it is that a lot of this will become a static canvas. It's called a lean canvas. And so basically it's a way of saying a business plan, right? But it's a little bit more lightweight because a business plan is normally oriented to make you sound good. If you write a memo, people will try to make it sound logical in that sense. So a lean canvas is basically saying, if I look at a startup, and this is maybe the areas they want to cover, do memos, what is the problem they're going after? What's the solution they're going after? What are the unique value proposition? What they're promising as a customer? What's the unfair advantage? And then who are the customer segments? Who are the personas of the people that are going after? Who are the early adopters in this persona? And then as a result, what are the key metrics they're delivering? What are the channels? How do we sell them? And then what's the cost structure, the variable cost, the fixed cost? And what are the revenue streams? How do we make money from this? And to some extent, it's defined by the product, and this is defined by the market in that sense. An example, I'll just talk out loud, but for example, we are looking at a company like Rippling. So Rippling, like Zenefits, is an all-in-one HR system in the US. There are similar companies in Southeast Asia. So Omni HR, Brio HR, there's a bunch of others. But let's just, so the definition, simple one would be the customer segment, the problem. Okay, so the unique value proposition is we are an all-in-one HR that handles payroll, leave, tax, expenses, recruitment. So it's all-in-one software, right? And we are targeting HR officers, but primarily HR officers from smaller companies or fast-moving companies rather than large companies. But it can't be too small. They can't be 10 employees because that way you can do it yourself, but it needs a certain size. So these are segments we're going after. And as a result, the problems we're going after is they have a lot of fragmented systems. They don't talk to each other. It's unproductive. They do a lot of manual work. And therefore, our solution, the top 3 features is all-in-one. Number 2 is digitized. Number 3 is interoperable with other extensions and automations, for example. And then as a result, the key channels that we sell is we do a sales force, we do marketing. The key metrics we measure is productivity, outputs, and so forth. Cost structure is software as a service. It's a classic data engineering cost to set up, but it's primarily fixed cost, not very little variable costs because digital software. And the revenue stream is we charge it per seat. So for every employee that's in your company, we charge $3 Singapore dollars. And then if you want to add another module, it's another $1, and so forth, right? So as a Singapore company, have 100 employees, and you're using 3 equals $5 per user, the modules. Therefore, 100 employees times 5 equals $500 a month, times 12 months is $6,000. And then if you install all-in-one HR system, you probably never uninstall it, right? For the next 10 years at least. So $6,000 of money that you make for 1 year times 10 years equals to $60,000 of customer lifetime value. So this is a way for you to think about the lean canvas, a snapshot of that business plan. And what you normally notice is that for startups, what they're very focused on all the time, and it's quite different from a lot of other companies, is that they're focused on the number one problem. So they are focused on the number one problem for this person. There's always a new number one problem that emerges or anything, right? So I always tell people like, okay, if I look at Rilling and I say, Rilling, do you want an ambulance now? No, right? But if I cut off your hand now, then I'll say, do you want an ambulance? You'll be a yes, right? Because that'll be your number one problem. The number 2 problem will be like sending Jeremy to jail, right? After that. But the number 1 problem now is going to ambulance. You need to think about startups that are always laser focused. They don't care about the number 2 problem, number 3 problem, but they very much care what is the number 1 problem. Because if it's not your number 1 problem, you just delay your buying decision to later, right? Number 1 problem is really important, and really important for you to understand who is having that number 1 problem. So you can't say, oh, large companies need all-in-one HR. No, who is it? Is it the CEO of a startup? Is it the HR officer of a medium-sized startup? You get what I mean? Who exactly is having that number 1 problem, right? When are they having that problem? It's very important. Because it's sometimes I was working with a technology company and they're doing cybersecurity, right? Basically what they said is, cybersecurity is the number 1 problem when, anybody wants to give a guess? When is cybersecurity the number 1 problem for you as a company? Is it when there's a breach? Exactly, exactly. When there's a breach is exactly the number 1 moment when people are like, oh, time to buy cybersecurity, right? You know what I mean? So there's the number 1 problem at that point. And that's reality, right? So there's a tricky part, which is that if someone has a data breach, it's probably easier to sell them a product at a point of time, which is I'm doing data correction and recovery, for example, and then I sell you the protection stuff later, right? Does it make sense? But so you think about when it happens and you think about why it happens. So it's the number 1 problem, right? If you talk about, we joked about getting an A for math. If primary 1 to primary 3, the parents are pretty chill, they don't care, they probably won't buy this. But primary 4 starts to heat up, primary 5, primary 6, there's PSLE, and people start to heat up, right? And then people are like, okay, I want to spend more on education because of the PSLE. But then if they're going to an integrated program, don't need to go through this primary 6 exam, then parents don't care either. Then they spend more chill, right? Sorry, integrated programs for secondary school to junior college. Thank you. The areas look at me, what? And I was like, shit, I got it wrong. And the point is that secondary school to JC. But then from JC, you probably want a good uni, you probably need better grades. I think you need to understand why people are having that as well. When you have cancer, the day before you got your cancer diagnosis, your number 1 problem was work, followed by my spouse is angry at me for not cleaning the dishes, followed by I don't have time to hang out with my buddies. That's your number 1, number 2, number 3 problem. And then you have cancer, that's your number 1 problem, right? Everything else is. And then everybody else will tell you, okay, your boss will tell you, don't worry about work, go fight your cancer. Your wife say, okay, postpone this fight for now. Let's fix the cancer first, we deal with it later. And then your kids, your friends and buddies will be like, okay, I'm here to support you. Your number 1 problem is cancer, right? So if your number 1 problem is cancer, then probably you want immunotherapy, you want any cancer, you want to see a doctor, you pay a lot of money to have the right solution, right? So that's a product that you want to have. If you're poor, for example, and you are a business owner, and then you're facing poor, then you may want working capital to expand your small business as a company, right? For example, in Indonesia, in Vietnam, it's very hard to access capital loans, right? Because the banks are very slow, they have very high requirements, they require personal guarantees. It's quite hard to access capital, right? And so startups that are able to spot the right small businesses there that the larger companies don't want to underwrite, but actually are good bets because they're hardworking, there's a good revenue growth, then they're able to lend and then make money on that capital as well. So you always have to think about that piece as well. And obviously, you wake up in the morning, you look at yourself, and then you're like, oh shit, I got 20 wrinkles on my fucking face. And then you're like, okay, you know what? Time to go to YouTube, look at longevity, aging, lasers, inside out, rejuvenation.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.